CMQ investors, I've been asked now by a number of you for my unfiltered take on SoFi stock. Now, I've been familiar with SoFi. It's hard not to notice SoFi because it feels like their name's being mentioned all the time. But this was my first time diving into the actual business, looking at it from the perspective of someone who might be considering buying a piece of it. And let me tell you, when you say SoFi, I say no thanks, because this business, as far as it being a potential investment for your portfolio, no way. This is a piece of shit company. I don't even understand why anyone would want to own this. And I say that not because I think I know everything. I legitimately don't understand. Like, this company bleeds money. I like businesses that have financial strength. I like businesses that have strong balance sheets. Now, not all investors have to invest that way. I'm just telling you basically what allows me to be comfortable and sleep at night. And this leads to my next point. No track record of delivering returns for investors. You know, SoFi is new, just to be fair. It's a company that was brought forth or brought public through a SPAC, which is a whole nother topic of conversation, actually.
Chamath Palihapitiya announcing here on halftime his latest special acquisition company will merge with the popular fintech firm SoFi.
Leadership and character really matter because you are faced with incredibly difficult decisions of policy, of morality, all kinds of things.
There's a lot of competition, and that competition is not just among other innovative startup type of companies, but also the legacy banks that SoFi had been so outspoken about wanting to disrupt. You know, those banks are not playing around, and I know that because I've been on the inside. We could talk about that in another video as well. Let me move ahead a little bit, because I have a partial version of a checklist that I've been putting together based on what Warren Buffett and Charlie Munger have said makes a good business good over the years. And so if I look at this checklist here, and I think there's 9 items, I only could check one thing, but this might make you laugh. So superior reputation. Well, I would have maybe thought that, you know, it's something about like having a football stadium. I just assume that, you know, everyone loves you. But SoFi is unable to get past that 2.7 mark on Trustpilot, which, you know, that's saying something, guys. And if you read the comments, it's, you know, a lot of customer support issues, people just not getting what they thought they were signed up to get. But I can only imagine using this heuristic here that it's not going that well in terms of referrals, or at least not to the extent that I think their business model depends. Another thing here that was funny, low cost distribution method, which can just mean like low marketing costs, but they have a football stadium. So this fourth thing that I put in here is what gives me a real pause. Anytime I come across a company that gives me any sense of like the heebie-jeebies, not even that extreme, just something where I'm like, you know, maybe they could have worded this differently, or they could have been a little bit more forthright. I'll show you exactly what I mean. So the first thing that popped at me was the fact that their brokerage line of business profits from payment for order flow. That to me does not seem like, you know, you're doing the right thing for your customer. And I have a bias there. I don't like payment for order flow, especially when I think it's just still not fully understood by the consumer. It also tends to be among platforms that are encouraging lots of trading, which we know from our research, that the more investors like us trade, the worse we do long term. So, you know, your business model incentivizes you to encourage your customers to do something that's bad for them. I don't think that works out long term. I'm not saying their entire business is based on this, but look at Robinhood. I think I called that pretty well. Next up, though, SoFi talks about their members. That's one of their, I'd say that's like their number one kind of lead-in metric. In their recent earnings presentation, they note they have a record growth in new members. That sounds great, but then if you zoom in a little bit, I wondered, you know, what is a member? And sure enough, we Detective Franco on the case. A member is someone who has a lending relationship with us through origination and or servicing, someone who opened a financial services account, linked an external account to our platform, or signed up for a credit score monitoring service. Oh, and once someone becomes a member, they are always considered a member unless they violate our terms of service. So you're never going to see any churn. That's not what you do. And I'm saying this as someone who, you know, I don't want to like get too into my career here, but this is my bread and butter. Like, I would never present something like that. I'm in a business where my numbers, my growth metrics, my results are scrutinized at all levels of the C-suite. And I would never put forth something like that because it's just bullshit. I don't mean to say it like so crass, like these are bad people. That's not what I'm trying to imply. Hopefully no one thinks that, but I question the judgment of that. Furthermore, I really question the judgment, and this goes back to the actual SPAC. I did some research, and Chamath was the sponsor, and when he posted a one-page thesis about SoFi, and he mentions in the quantitative section that they have best-in-class CAC, which stands for customer acquisition costs, and churn. And again, we know what churn is. That's, like your retention. But they don't say what the CAC is. They also don't say anything about the churn itself. And from what I just showed you, how would they have churn if everyone's always a new member? I don't follow that completely. But the bigger point, because there could be some nuance there, the bigger point is they don't say what the best-in-class CAC is. That doesn't tell me anything. And from what I can tell, based on the number of new members added this past fiscal year and the amount of money they spent, I strongly push back on that. In investing, there's no certainties, it's just probabilities. So, what is the probability that SoFi is able to do what it is they say they're trying to do? When we consider those three factors I mentioned, they're bleeding money, they don't have a track record, and they have a lot of competition, and that doesn't even get into the whole kind of sketchy, questionable ethics side. I don't feel like this is a high probability event. SoFi in their deck, they mention here, they say there's over 500 million accounts for grabs across 4,700 FDIC incumbent banks. And the top 10 legacy banks hold 50% of consumers' 500 million plus bank accounts. So let's just stick on that for a second, the big banks. Sure, some of them will lose customers. They won't adapt fast enough. That's to be expected. That's just kind of how business goes sometimes. But what I don't think is being considered is SoFi is so dependent on this narrative that they'll be able to cross-sell because they offer all these different services. So if somebody signs up for a brokerage account, then next thing you know, they're doing their mortgage with SoFi. I find that to be easier said than done. This idea that there is over 500 million plus accounts that are just up for grabs, I don't buy that. And look, I hope the numbers prove me wrong. I don't root for companies to do poorly. If anyone's watching this from SoFi, I know I just pretty much ended the chance that anyone from that company will ever want to sponsor anything on CMQ Investing, but that's okay. I'm here to be honest with our audience, and I hope that the company is able to realize its vision, because why would I root against that? But going back to my approach here as a trying to be a rational investor, I'm looking for high probability events. There's not many stocks that I need in my portfolio, period. And for a business that's just bleeding money, we're talking bleeding like their last 12 months, their free cash flow was negative 1.4 billion. Total debt last quarter was 4.2 billion. We're in an environment where interest rates are rising. Who knows? But that's just not something I really want to pour my money into right now. It's capital intensive. There's no history of showing really strong returns on invested capital. There's none of that actually. And I get a little bit of a sketchy vibe, or a little bit of a vibe based on some of the ways that they frame things. It's just not for me. But if it's for you, I'd love to learn more. Maybe I'm missing something here. I'd love to hear the thesis. Let me know what you think in the comments. I hope you'll subscribe to the channel. Thanks so much for watching. For CMQ Investing, my name is Chris Franco. We'll talk soon.